It's Brian Preston, the Money Guy.
This next question is from Jordan. And Jordan said, question, at what point should people consider permanent life insurance? I have heard only consider it after maxing out all other tax-preferred investment options, 401k, HSA, Roth, etc. Would you agree that the assessment is, after you max out all your retirement stuff, your 401k, your HSA, and your Roth, because you've maxed those out, the next thing you should do is permanent life insurance?
No.
No, I would not either.
I mean, realize you have to know the why. Insurance is exactly what the name implies. It's to hopefully protect you from some concern you have, catastrophic event out there. So there's a lot of things you can do. And, when you buy any type of insurance, you're basically admitting, hey, I just don't have the resources to cover this exposure I have. So I'm going to pool my concern with all these other people that have the same concern. And we're going to use, since it's such a small likelihood of this happening, us all pooling our resources together and paying a little bit of cost towards it is going to help me just bridge this until eventually what you're hoping with a lot of exposures is if you're financially successful enough, you self-insure.
Yep.
That is but the problem with life insurance is most of us when we're younger, we start making income, we have spouses, we have children, we have commitments, whether it's debts like mortgages, whether it's college funding, whether it's just making sure your family has income if you're no longer here. It takes a while to build your nest egg up big enough to basically self-insure. It's a big gap, especially when you're in that messy middle of in your late 20s, early 30s, even 40s. You have all these commitments, but your assets just haven't reached that critical mass to the point. This just makes sense. Go buy insurance, especially like term insurance is so cheap. For a few $100s a year, you can typically buy yourself $500,000 to $1 million of coverage for just not that much cost. Permanent insurance is a little different than term, is because, as the name implies, permanent in theory is supposed to last forever. Whereas term, you either buy 10-year, you buy 15, you buy 20-year, but at the end of that term, it doesn't mean the insurance goes away, but it means that set premium at a lower cost is going to go away, and you go truly start paying the cost of insurance right now. And that's where it gets really where it's not cost effective. Whereas permanent, they flip the script upside down. They say, look, while you're young, we're going to make you overpay your premium so that what the cost, the difference between what you're paying in premium versus what the true cost of insurance, we'll kind of keep the difference. We'll pay some fees too, but we'll keep the difference and let that build up in the background so that as you get older and the cost of insurance is super expensive, you'll have enough that kind of mitigates that cost over the long term. So this insurance can be permanent. Here's the catch though. Permanent insurance costs 20 to 25 times what term insurance costs. And look, when you're in your 20s and 30s, every dollar you save and invest has the potential to grow 23 times. If you're under 25 and you're between 20 and 25, I mean, it's somewhere between, it could grow 88 times. So you can see every dollar that you're overpaying in insurance could get very expensive. So I think for the lion's share of people, term insurance is what you ought to consider. Now, I feel like I have an expert sitting to my left. And we have had cases where permanent does make sense. I feel like after we've now poked a lot of holes in why the majority of people should do term, don't skip the steps of figuring out what you need, but walk them through where permanent actually does make sense.
Yeah, so there are times where maybe you are part of a family or your circumstance puts you in the issue. We're going to have some estate taxes, maybe either in the state that you live in or federally based on the size of your portfolio. But a lot of your assets are maybe in a business that is illiquid or in illiquid real estate holdings, or you don't have a lot of liquid capital, but there are going to be taxes assessed when you pass away. So one of the most common uses we see for permanent insurance is to satisfy any outstanding liabilities, like tax liabilities, that might be present when you pass away so that your heirs, your family, doesn't have to liquidate illiquid assets or perhaps liquidate assets that they don't want to have to sell otherwise. That's a pretty limited case study, right? I think one of the things that really frustrates me when it comes to like the insurance industry is a lot of insurance salesmen want to make whole life, permanent life insurance broadly applicable to the masses, and I just don't know that it is. And in our world, we like for investments to do the investing thing, and we want for insurance to do the insurance thing. And when you try to begin combining those two, you actually end up of a suboptimal, sub-efficient mix of both. Now, I can already feel the comments coming in where people are like, yeah, but it's tax-deferred growth. It's tax-deferred growth. Yeah, there is an option that you can defer the taxes on growth inside of an insurance product or policy. The problem is when you have to go to take that money out, when you want to go use that, you have to borrow the money from yourself. You don't actually get to make a distribution. If you do make a distribution, the policy goes into lapse, well, then it all becomes a taxable event anyways, right? So was that tax-deferred growth really that valuable, or did you just captivate your money forever to where either it will become taxable or you have to die first? I just don't love that mix of setting up insurance and investing to overlap. I think they should be two separate and distinct things.
Yeah, I mean, you hit on something that's in all the life insurance brochures is that hey, you can just go borrow from yourself and you won't pay any income taxes.
Why should I have to borrow my own money?
I don't like that it takes away your ability to vote with your feet because I just shared with you guys, you will reach a point, let's just say you're in your 70s, the cost of insurance gets expensive.
Yep.
And what if you are sitting on multiple seven figures, but you've got this premium because you took loans to put the kids through college, because somebody convinced you, hey, that'd be a great way to pay for college was just go borrow off of these permanent life insurance. Because you ate out part of the cash value, you brought it down to a point. Now you're still making premiums payments, but you're like, this is just, I don't
ridiculous.
need to keep making these insurance payments, but you have to. You are now married to this policy because if it lapses, you have a huge tax bill that's due. So it's just a weird situation because you can't vote with your feet. The only way you can get away from the liability is to die with it so that it's not like your family gets the full death benefit. Part of that death benefit will be to pay down the loan that you took to pay for college, but you'll at least be freeing them of the obligation of paying your health life insurance. That's not the greatest thing. I more daydream that you build your army of dollar bills up, you buy term life insurance to cover all of your needs, like your kids. That's why you have the kids. What do you think? When do they go leave the nest to be on their own? Have the term insurance go away then. You can layer multiple policies. Maybe each time you have a kid, you buy a new life insurance policy. Maybe when you bought the big house that you're raising all the kids in with the mortgage, you bought a policy that covered that. So then as these life events start falling off, like the kids leave the house, the mortgage is paid off, the insurance starts going away each time those life events occur. So you do get to that point where you're in your 70s and all your debts are paid. You don't need your army of dollars. You don't need to be making money because your army of dollar bills are doing it. You've taken away, you've simplified your life by removing encumbrances and obligations and simplified things so you can enjoy the fruits and the abundance that you've created for yourself.
I love it. Love it. Love it. Great question.